Welcome to Invested Insider, your trusted source for the latest financial news and insights. Today is 23rd of May of 2023. In this podcast, we will cover how the debt ceiling angst has caused Treasury bill yields to approach 6%, prompting investor concerns and uncertainty in financial markets. The recent surge in debt ceiling angst has triggered a wave of uncertainty in financial markets, with Treasury bill yields inching closer to 6%. Investors are growing increasingly concerned about the potential consequences of a failure to raise the debt ceiling, which could result in a government default and a range of detrimental effects on the global economy. This article explores the implications of this ongoing issue, highlighting the impact on Treasury bills, stock markets, and the search for safe haven assets. Investors seeking to protect their investments from the risk of a government default are demanding higher yields on Treasury bills. The yield on the 3-month Treasury bill has reached its highest level in 14 years, reflecting the growing unease among market participants. Similarly, the yield on the 10-year Treasury note has reached a 3-year high, as investors seek to offset the perceived risks associated with the debt ceiling uncertainty. As debt ceiling concerns escalate, investors are also adjusting their positions in the stock market. The article notes that investors are selling stocks amid uncertainty, which could potentially lead to increased market volatility. In response, many investors are turning to safe haven assets like gold, driving its price to a 2-year high. Gold's historical role as a store of value during times of economic uncertainty makes it an attractive option for investors seeking to hedge against potential market turbulence. Should the U.S. government fail to raise the debt ceiling, it could trigger a government shutdown and potentially lead to a default on U.S. debt. Such events would have catastrophic consequences for the global economy, causing investors to reevaluate their risk exposure. Consequently, some investors are turning their attention to alternative havens outside the United States, such as Switzerland and Japan. These countries offer strong economies and stable governments, which make them appealing destinations for investors in search of safety. An additional concern stemming from the debt ceiling angst is the potential impact on the U.S. dollar. As uncertainty lingers, a sell-off in the U.S. dollar has been observed. Given its status as the world's reserve currency, a weaker dollar can make U.S. goods and services more expensive for foreign buyers, potentially hampering the U.S. economy. This dynamic could further exacerbate the risks associated with the debt ceiling and increase the likelihood of a global recession. The current climate of debt ceiling angst has heightened uncertainty in financial markets, spurring investors to demand higher yields on Treasury bills. The potential consequences of a failure to raise the debt ceiling, including a government default and a weaker U.S. dollar, have prompted investors to reevaluate their portfolios and seek alternative safe haven assets. The global ramifications of this issue underscore the need for a swift resolution to avoid a government shutdown and the catastrophic impact it could have on the global economy. As the situation unfolds, market participants will closely monitor developments, looking for signs of progress and stability. Thank you for joining us on this episode of Invested Insider. We hope you found the information valuable and insightful. Remember, the world of finance is constantly evolving, so stay tuned for more updates and analysis in future episodes. If you have any questions or topics you'd like us to cover, feel free to reach out. Until next time, happy investing and may your financial journey be filled with success. Goodbye.
The Invested Insider podcast does not offer any financial, economic, legal, accounting, or tax advice or recommendations. The information provided in this podcast or on the associated blog should not be construed as investing or financial advice and should not be considered professional advice. The views, opinions, and content presented in this podcast do not represent the endorsement or approval of Invested Insider and assumes no responsibility for the accuracy or completeness of third-party materials or content referenced in the podcast.